Hey everybody, and welcome back to the Blockworks Macro YouTube channel. This week, we are not going to cover an article of the Macro Compass because an important news actually hit the screen in the meantime. And that news is that the European Central Bank decided to play hardball on monetary policy. That's the first time in basically ever when it comes to the European Central Bank. And I think the European Central Bank meeting of yesterday is the most iconic one since the Draghi era. So instead of going through the article of the Macro Compass, I want to go through a thread that I published on Twitter that walks you through what exactly happened yesterday at the European Central Bank meeting. As I said, I think this was the most important ECB meeting since the Draghi era. There are relevant market implications, and let's go through it. I think Lagarde couldn't be more clear than this. The ECB has woken up to the risks of inflation becoming anchored, and she was super clear that the ECB doesn't even remotely intend to pivot dovish. They intend to keep policy very tight for the long run until inflation slows to 2%. Now, the three crucial points in the presser were the following. First, the ECB foresees core inflation at 4.2% by December 2023. And that's correct, you heard me right, 4.2% core inflation by December 2023. Despite a bunch of rate hikes, the ECB thinks that core inflation will be at double their target in a year from now. And this is the table here, where HICP, excluding energy and food, by 2023 is expected to be above 4%. Now, this forecast was just the initial taste of what Lagarde really meant in the European Central Bank meeting, is that they are going to hike much more than what the market expects. They want to make sure that inflation doesn't become anchored. The second important point was that quantitative tightening in Europe is going to start in Q1 2023. Again, you heard me right, quantitative tightening in Europe. And even if it starts small at only 15 billion a month, it's basically a virtual certainty for the European Central Bank. They're going to bump it up at 30 billion a month, starting in Q2 next year. But most importantly, this will shrink the European Central Bank balance sheet on top of the already shrinking European Central Bank balance sheet. You can see this is the excess liquidity in the Eurozone dropping from 4.8 trillion to 4.5 trillion, 300 billion already of shrinkage of the balance sheet at the European Central Bank because of TLTRO repayments, these cheap loans that were given to European banks during the pandemic. The European Central Bank is now trying to pull the incentive scheme towards European banks repaying these cheap loans. This shrinks the balance sheet of the central bank, and quantitative tightening is going to add more on top of that. So Lagarde wants a bunch of rate hikes more, and she still thinks that core inflation is going to be double her target by December 2023. Despite of that, she kickstarts quantitative tightening that piles up on the TLTRO repayments and shrinks the ECB balance sheet further next year. And on top of it, the cherry on the cake was that she basically said, hey, bond traders, you're pricing the terminal rate in Europe at 3%. Forget about it. It needs to be much higher than that. Now, this is easily explained by thinking that in history, every time a central bank wants to fight inflation, they need to bring nominal rates above the level of core inflation. Now, some basic mathematics for December 2023. Remember, nominal rates are real rates plus expected inflation. Now, if the expected core inflation by December 2023 is over 4%, and to fight inflation, you need to bring nominal yields above this level of core inflation, that means the European Central Bank wants at least to see markets pricing in nominal terminal rate at 4% or higher, above the level of core inflation. As we enter the market, as we enter the meeting, the market was pricing terminal rate only at 3%, 1 full percentage point below the level of core inflation that ECB expects by December 2023. So basically that doesn't square. And look at this chart. It's obvious that Lagarde wants to see bond markets pricing in much higher nominal interest rates, because the last time that a central bank in Europe had to fight inflation, let's say in the 90s, let's take the example of France, where the average inflation in France between 1989 and 1991 was roughly 4%. Back then, yes, the economy was stronger, which means the nominal neutral rates were higher. Productivity was higher, population growth was higher, we didn't have all this debt overhang. Like today, nominal neutral rates, the blue line, under my estimate, were roughly 4%. Nevertheless, the Banque de France had to push interest rates to 8% for 2 years to slow inflation down. Now, if today nominal rates in Europe are estimated to be roughly 2%, that means the European Central Bank wants to see the market pricing rates at 4% for a while to be sure somehow that inflation is going to come down. And the market wasn't nearly pricing that. Let me give you an impression of what the bond market was pricing. This is throughout the conference of Lagarde. So as she was trying to push this pricing higher, the bond market only went to price terminal rate as high as 3.25%, a full percentage point below the core inflation the ECB expects by the end of next year. So way short of what Lagarde wants to see these rates priced. And that means that she has to push more and more and more. Now, when she pushes these front-end yields in Europe higher, what she's doing is exactly like in the US, she's going to end up inverting yield curves more and more and more. The chart that you see here is a 30-year history of Germany 10 to 2-year yield curve slope. It's negative 31 basis points. And I think if she keeps doing this, this is going to be negative 100 basis points. Basically, the European Central Bank is effectively bringing Europe in a recession. The problem is that the bond market, I think, hasn't yet fully appreciated the problem. First of all, front-end bond yields need to go much higher. Curves will invert much further. But the second important point is that weak links in Europe are going to suffer massively. Italy is obviously the first candidate where the spreads between Italian government bonds and German government bonds are already blowing up after yesterday's press conference. But contrary to what happened over the last 10 to 20 years, the European Central Bank this time cannot also try and rescue Italy. They have one mission, which is to bring down inflation. There will be casualties, the housing market, Italy. There will be other risk factors in Europe that will pop up to the surface, but the European Central Bank is trying to fight inflation and gain credibility there. They have one mission. They've been very clear yesterday. This has massive market implications. She's not only going to bring Europe through a recession, she's going to have basically an employment rate go up. She's going to have the housing market correct down by 20%. She's going to have Italy, Greece, Spain, Portugal suffer a widening of spreads against Germany. And this time, compared to the last 10 years, effectively, the European Central Bank cannot come to the rescue at the same time. It's very, very important, I think, if you are a European investor, but also a US investor, wherever you're listening from, to understand what the dynamics in Europe will be over the next 3 to 6 months. Now, talking about that, guys, you should know that this is my last free video of the Macro Compass for the Blockworks Macro YouTube channel. After today's show, there will be no free videos anymore, but the journey will continue on the macrocompass.com platform. Now, the reason why I'm doing this is YouTube videos, newsletters, my Twitter account, they are a good way to share information. And I'm grateful for all the support I've received on this channel, on the other media channels. You guys are great. My intent, though, is to make you a better macro investor, to step up your macro game, to share everything I've learned running a $20 billion portfolio with you guys. To do that, a newsletter, a YouTube video, a Twitter feed is not enough. We want to step up the game for you. And therefore, we're going to launch paid subscriptions, 3 different tiers: the long-term investor, the all-round investor, and the pro investor. Those are 3 tiers. You can see the price and the products on the screen here, to basically make you choose what kind of product you want. The products work roughly this way. The long-term investor will deliver a weekly newsletter to you and will deliver a long-term ETF portfolio. This will be fully investable from any jurisdiction and reflecting the Macro Compass macro models and analysis on macro. Also, there will be a 25% discount on all macro courses that I will be delivering next year. They will cover anything from central bank mechanics to portfolio management to risk management and macro analysis. The all-round investor will deliver to you all the long-term investor product On top of it, you will receive tactical market reports. Every time there's a big event like the ECB meeting yesterday, the Fed meeting, the labor market report, a big market move, you will be receiving it, my macro coverage, straight in your inbox the very same day. You will have tactical trade ideas on top of the ETF portfolio to implement in a more tactical fashion. Most importantly, you will have access to interactive macro tools, something I'm extremely proud of. Basically, I will be sharing with you all the tools that the pros use to screen the market, study macro, find trade opportunities, and understand this global macro puzzle better. I'll give you access to the data and the type of analysis that the professional investors do when they take macro decisions. Because remember, the aim is for you to become a better macro investor. Also, the discount on macro course will increase to 50% in this tier, and there will be a Q&A group, monthly Zoom call, where I will get questions as well from you guys, and I will try to answer all the asset allocation, trade, and macro questions you have. If you're an institutional investor, there's a tier for you, which is called the Pro Investor, where you get the all-round treatment, plus you get the monthly institutional deep dive piece, you get pro dedicated trade ideas, pro dedicated tools, and on top of it, you can also book me for private consultancies if you want. Guys, these are the tiers. The website is on top, themacrocompass.com. If you want to, the landing page directly for the tiers is themacrocompass.com/subscribe. Please pay a visit. I will be looking forward to go through this macro learning journey with you guys in 2023 on themacrocompass.com. In the meantime, really thank you from the depth of my heart. I'm a Southern Italian. I really appreciate the support that you have given me throughout 2022. A kind word as well to Blockworks. Keep following the Blockworks Macro YouTube channel. The Macro Trading Floor shows stays on the Blockworks Macro YouTube channel. And we will talk again soon on the Macro Trading Floor. And I'll be waiting for you on the macrocompass.com on the paid subscription tiers for this macro learning journey together. Talk to you guys next time.